What we found in our survey of CFOs this year was that they are concerned about a number of things that face their businesses during critical times. Cash flow is important to them, particularly clarity around the cash flow, so not just how it's going, but how it's expected to go, forecasting and budgeting and planning. Resources for themselves and their departments, as well as the skill sets of the people who work for them. They're also concerned with an aging workforce and turnover at the lower levels, so that they're concerned about succession planning, not only for the current year, but for the future of their organization. They've also they've got a focus on regulatory issues. A number of regulatory issues have cropped up over the past few years, in particular around income taxes, the Dodd-Frank Act if they're in financial services, what the PCAOB, which is an indirect regulator of theirs, it regulates their auditors regulate them, and so that the flow-through effect of some of the changing regulations there have also had an impact on them. But in putting it all together, what they're really finding is that they have the need for a more holistic approach, which is to say that they are best serving their own careers as well as the companies for which they work if they're involved in the entire continuum of data, not just producing the financial statements that say how the earnings went and how the balance sheet looks at the end of the year, but how the strategy was achieved. And so that's requiring them to be involved on the front end, and they're looking to be involved in setting the strategy and then understanding the data flows that will tell them what key points of information allow them to realize whether or not they've met their strategy. And so the holistic approach is something that's increased in importance to them. All of the items on the list, or virtually all the items on the list, are the same as last year. They're in roughly the same order. But one of the things we did notice is that when we asked people to grade the level of intensity or interest or severity, if you will, on a scale of 1 to 10, just about every category, while it's on the list, had a higher number. So things were coding in the low to mid 7-point X's, where last year perhaps they were a 5. So still on the list, but they're more anxious or more concerned or more focused, depending on the issue, with the same things, with a few new things that have been added. Risk management made the list for the first time. And we see risk management making the list as part of that idea of the continuum. You know, CFOs obviously are involved in managing risk for the company around financial reporting, cash flow, and strategy, but in this instance, what we're seeing is that they feel the need to be involved in the risk management process that allows them to be in a position to understand how it is we'll measure whether or not the risks have been achieved. I mean, it's easy to say, well, we made the numbers, we must have achieved all of our objectives and managed all of our risks, when in reality there are more important data points than that. And so they're being expected to come up with that data, and so they're needing to interface with legal, with chief management executives in other departments, logistics, in the offices of contracts, the CIOs in particular. A lot of their success rides on what the CIO is able to do for them in terms of getting them in on the budget and the priority and making system changes to enable them to get the information that they need. The holistic approach also is finding its way into the need for the big data initiatives. One source of the truth, if you will. One level of and set of data for the entire company that will drive operational and financial outcomes, and so that the reporting comes from the same source. And that would obviously drive the need for a system that speaks to all of those issues in an integrated fashion. This, part of the CFO's challenge in dealing with the holistic approach we're finding is being invited to the room. Historically, they may not have been part of the risk management process. They might not have been part of all of the strategy setting, maybe the financial modeling. And now they need to be involved on the front end so that on the back end they're in a position to manage that. We're finding that there's risk with that. It obviously puts them in a more exposed position. When all of the issues they have and are focusing on are more intense or more important or more areas of focus for them than they were last year, but they're dealing with the same pool of people, they're working harder, but we believe that there's a good outcome for them, which is that on the back end, they're going to improve their value to the organization. With regard to revenue recognition, we're advising our clients to look at this in two ways. There's the new rules, which are coming at some point in the future. At present date, they're expected to be required in 2017, but companies have a policy decision to make now, which is whether or not they're going to do so prospectively from 2017 forward, or retrospectively, which would bring in 2015 and 2016. And they're going to need to start gathering data, collecting data, or creating a system by which they can go back and get it, should they need to do so. It's possible that that standard will be delayed. We won't know until the middle of 2015 if that's the case. And if it's only delayed a year and companies wait until then to find out whether it's been delayed, then they will have wasted the first half of the delay period. We advise them to continue their activities in earnest so that they take advantage of any delay they might get, not to delay, but to be better prepared. As it relates to current rules, however, the PCAOB, the indirect regulator of public companies, has put out a practice advisory to external auditors, which might require work now under the current rules. Companies may have to write white papers or position papers around issues such as gross versus net revenue recognition versus the timing on allocation of cost and revenue to multiple element deliverables. And they may need to do that now for their auditors to satisfy this year-end's requirements. It also may be manifest in larger sample sizes, which for them may not be terribly difficult, but their internal audit organizations, if they're supporting the external audit, may have to deal with more samples, more geographic coverage, more coverage on segmentation, and certainly the higher bill that might come from those expanded audit efforts. And so we're recommending that companies look at RevRec in the context of the current rules, because they have to get through this year and the next two under those rules with the benefit of what the PCAOB is encouraging their auditors to do. But then they also need to be ready for the new standard and make that key election, which would determine whether or not they need to start work sooner rather than later. And we would say that no harm, other than perhaps doing a little more work than you'd like and perhaps spending a little bit more money than you'd like, can come from being ready to retroactively adopt the standard. There could be tremendous harm if you get to 2017, decide you want to do it, and realize you can't go back and do it.